In the UK, if you have a private pension plan, then currently you have to wait as a minimum until you are 55 years of age before you can start accessing the money in your pension without being penalised. And for some workplace pensions, this age could be higher. Once you get to this minimum age, what are the tax implications of withdrawing your pension and how much can you take tax-free? In this video, I'm going to cover a refresher on how to get tax relief on your pension contributions, how you can draw down funds from your pension pot, how can small limited company business owners take a tax-free loan from their pension pots, and finally, buying a lifetime annuity and taxation. Pensions are a powerful tax shelter, so in other words, you get tax-free contributions into your pension pot and any growth in your pot is free from capital gains tax or any other taxes. In the current tax year, you as a UK tax resident is able to contribute up to £40,000 per annum into an approved pension pot tax-free. And don't forget, there is also a lifetime allowance, currently £1,073,000 per the 21-22 tax year. If you want a more in-depth refresher on the top 3 ways to get tax relief on your pension contributions, we've done a comprehensive video on this, which you can access by clicking on the link in the description box below. At the beginning of April, we granted early access to the Accounting and Tax Academy membership site. In July of this year, we're opening our doors to everyone. Our members will have access to in-depth tutorials, free downloads, and exclusive discounts. And the best part is, it's absolutely free to join. Head to the link in the description box below to register your interest today. There are in effect 2 common ways you can draw down from your pension. That is, of course, once you've reached the minimum retirement age, which is currently 55. Firstly, you can take a lump sum of up to 25% tax-free. And secondly, you can buy what is called an annuity. In other words, a regular income for the rest of your life. Up until recently, the amount of money you could withdraw from your pension was tightly controlled by the government and various legislation. But you now have more freedom as to how you can manage the drawdown of your pension. For the first time, you as a pension saver has the ability to control your tax bills by making controlled and managed pension withdrawals in some tax years in comparison to others. So timing your pension drawdown is an available and effective strategy to help you control your tax bill. So when you reach the minimum pension age, you can move some or all of your pension pot into what is known as a Flexi access drawdown. This is best explained with a common example. Paul is 56 and is still working as a higher rate 40% taxpayer and has a pension pot currently worth £250,000. He wants to take £10,000 of his pension tax-free for now, as he has passed the minimum retirement age of 55. So he transfers £40,000 into a Flexi Access drawdown plan and takes 25% of the £40,000 as a tax-free lump sum, equaling £10,000, and leaves the remaining £30,000 in the drawdown plan without taking any additional taxable income. So Paul has achieved his objective of withdrawing for himself £10,000 from his pension pot without having to pay any tax. Then 3 years later, he transfers another £40,000 into the same Flexi Access drawdown plan and takes another £10,000 of tax-free funds. He leaves the remaining £30,000 in the drawdown plan along with the other £30,000 from 2 years ago, now giving him a total of £60,000 in the drawdown plan. So basically, Flexi Access drawdown allows you to take your tax-free lump sum on its own without any additional taxable income, allowing you to park the rest of the funds in the drawdown plan. And what's more, the £60,000 currently in Paul's drawdown plan continues to grow tax-free until Paul decides to withdraw parts or all of it. And Paul can keep doing this until he has drawn down all of his pension pot into a drawdown plan. But you need to check with your pension provider if they offer a Flexi Access drawdown. And if they don't, perhaps you might want to consider speaking to a professional advisor to switch providers. UFPLS. Wow. A bit of a tongue twister, and bless those civil servant reformers who come up with such acronyms. UFPLS is similar in how it works to a Flexi drawdown, but there is a subtle and effective difference. Again, let's use Paul's example to illustrate. So we know Paul has a pension pot worth £250,000 and wants to take just £10,000 out of his pension tax-free for now. So under UFPLS, Paul will withdraw £40,000 and take 25% of this tax-free, so £10,000. The difference is that the remaining £30,000 has to be taken as taxable income simultaneously. He can't park it in a Flexi drawdown plan. And let's assume Paul is a 40% taxpayer in the tax year. He takes the £30,000. He'll be subject to £12,000 of income tax on this withdrawal. Ouch. So now, can you see why your timing is crucial if you want to optimize, if not minimize, your tax bill? Continuing with Paul's example, because he is still working, he could be subject to the money purchase annual allowance. From the 6th of April 2017, the money purchase allowance was reduced to £4,000 per annum. But what does this actually mean? So under UFPLS, in the previous section, Paul withdrew £40,000 in total from his pension pot at the age of 56. And as a tax-paying employee, despite surpassing the minimum retirement age of 55, he can still make further contributions to his pension pot, only he will be limited to just £4,000 gross per annum, hence the money purchase allowance. This compares to the usual £40,000 per annum tax-free contribution allowance. So just be aware of this. Now, if you run a small business through a limited company, you can set up and contribute to a pension scheme called a SSAS, a small self-administered scheme. An SSAS is a type of occupational pension scheme, a defined contribution scheme typically established by owner-directors of small limited company businesses. They are very common in family-run businesses and are open to all employees and their family members up to a cap of 11 individuals. One of the benefits of an SSAS is that it allows more independent management of it as a pension scheme in comparison to more traditional occupational pension schemes or even a SIP. So as a result, an SSAS pension scheme can provide a commercial loan to your company tax-free in order to purchase an asset, such as a new piece of equipment or for a variety of other commercial reasons. But a note of caution, whilst borrowing money from an SSAS pension scheme may be more attractive than borrowing from a bank or financial institution, a SSAS pension scheme cannot give your company a soft loan with no interest payable and flexible repayment terms. There are certain rules that have to be fulfilled in order to avoid what is known as an unauthorized payment tax charge. Head on to our free download which explains these rules in more detail. Nonetheless, get it right, and an SSAS pension vehicle is a very slick way of channeling contributions tax-free into a pot and then using some of those funds, again tax-free, to invest in your business. Historically, the most common option for accessing your pension pot money was buying what is known as an annuity. In other words, you essentially use your pension pot to buy a guaranteed lifetime income. Again, let's explain this better with Paul's example. We know he has £250,000 in his pension pot. So let's assume Paul is now 60 and no longer working, so he decides to cash in on his pension and takes a full 25%, that is £62,500 as a tax-free lump sum. For the remainder of the £187,500, Paul buys an annuity, a lifetime income from an insurance company. Now, annuity rates are often linked to interest rates, and in the current climate, as we know, the official Bank of England base rate is only 0.1% at the time of this video, an all-time low, so don't expect annuity rates to be particularly great. However, let's take a look at what is available for a single person on a standard basis. This reputable website, sharingpensions.co.uk, is showing rates of around 3.8% to 7% dependent upon your age, although actual rates will depend upon quite a few variables. Annuities are often maligned by the media and seen as a con. The idea of lots of retirees pooling their money together, and those that live longer than average are subsidised by those who live shorter than average, and I guess that is fair enough. But the one advantage of a lifetime annuity is just that. It's for your entire lifetime, and if you do end up living into your 90s or beyond, then at least it provides you with some peace of mind and, dare I say, a reasonable return on your pension pot. Thanks for tuning in, and I hope you find this content empowering and helpful. Finally, be sure to like and subscribe, as this really does help us to get our content out there, and your support is much appreciated.